What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is October 4th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got to talk about how something is breaking behind the scenes of financial markets. I'm not being melodramatic here, guys. We have got to start paying attention here. We've got to look beyond just analyzing at Bitcoin and crypto here, because something big is going on in the financial system, and if we aren't aware of it, it could catch us off guard here for where crypto may be going in the near term and over the next year. We've got a lot to unpack here in today's video. If you guys happen to enjoy the conversation, consider dropping a like. It's one of the greatest ways you can support the channel. And let's go ahead and kick off the rambling. All right, guys, we're going to be diving back into Bitcoin here as we go throughout the conversation, but I don't want to start off with Bitcoin price analysis here today. Not much has been going on here. More specifically, I want to focus on what's going on in the macro market, and more specifically going on in the bond or treasury market. Now, I understand at the end of the day, guys, some people ask me, Nick, why is it that I even need to be paying attention to bonds? I'm not investing in bonds. They seem boring. I want to focus on crypto, the latest, greatest altcoin that's going to 10x my money. At the end of the day, guys, this is critical for you, because if you are exposed to crypto or thinking about DCAing or thinking about going even into the most defensive plays like Bitcoin versus, say, Ethereum and going onwards towards the whole basket of altcoins, you need to be made aware of what's going on in the macro scene here. And unfortunately, as I look across the crypto space here, there are definitely some fintech or fin Twitter accounts out there that are covering it. I don't see many YouTube channels out there really covering what's going on here in regards to this discussion in the bond market. And I think it's again where we differ here in covering the macro scene, because as Bitcoin has grown as an asset into this massive multi-$100 billion asset, peaking at well over $1 trillion in the last bull market, we need to consider the fact that Bitcoin is a global asset now, for better or for worse. And because of that, I want to go ahead and spend some time here to talk about what's going on in the bond market here. We are seeing a historical change in the bond market here that is going to disrupt the investment thesis for investing in risk-on assets for the next few years, and also is a telltale sign of what's to come in the fundamentals of the economy, which, if they get towards a certain degree, are going to have a massive impact on markets. A big message I want to signal here, at the end of the day, guys, whether you are bullish or bearish, the fundamental thing I'm going to tell you that probably 95% of traders out there won't tell you is that the fundamentals do matter, and especially they matter when we're entering into a recession. That is a big dichotomy here that unfortunately has formed over the last few years, that a lot of people believe that markets are separate from it. We experienced that during COVID, when there was a massive injection of liquidity through quantitative easing that led stocks to rise towards their highest levels here from the lows in March of 2020 all the way here towards November of 2021 across the indices. However, the dynamics here are starting to change, and while 2023 was definitely a positive year from its absolute lows, we need to consider here that this was a relief rally, and I'm going to be spending some time to talk about that here. There's a lot of people telling you that it's a new bull market. You've probably heard their thesis. We've tried to unpack that thesis here on this channel and why we disagree with it, but I'm going to go ahead and spend some time to try to clarify what's really going on here and why the bond market is signaling some big worrying signs. We're not only seeing the Nasdaq and the S&P 500 pull back here from their relative highs back in July, as we've continued to bleed here as we go into the fall, but outside of that as well, the VIX has popped up towards its highest level since back in May of 2023, and it's gotten back above the long-term 5-year line of support, which showcases increasing uncertainty since back in 2017. A big point I want to spend here before we get into this is that essentially when we look at this volatility chart, an important thing a lot of you should understand is that we were likely heading into a recession in 2018. We were likely heading into recession, ironically enough, even if COVID didn't happen in 2019, because the Federal Reserve was starting to engage in quantitative tightening. And it was a matter of whether or not things were going to break today, tomorrow, or in a month or a year's time. But generally speaking, after a decade of easy money, we were looking like it was finally time to start breaking downward. However, we injected over 40% of the existing money supply in just 2 years into the entire M2 money supply in the United States, as the Fed continued to print money, as the ECB, as the Bank of Japan, the People's Bank of China, all the major central banks of the world, Bank of England, printed a ton of money. And that essentially allowed volatility to mitigate here, albeit never really returned down to its historic lows, continuing to send those higher levels. Well, we snapped through that range here. in March of 2023 as we had this relief rally, and now we're undoing it. So what's causing this? Why are we going back to more volatility? And why is it likely showcasing here that we're not ready for a new bull market? Why is volatility spiking up? Uncertainty, risk, and fear in the market. Well, the biggest reason for this has to do with what's going on in the bond market. The short-term yields, long-term yields on all major US treasuries are going up. Now, for those who don't know, treasuries are a specified name here to describe the federal government's debt in the United States. Essentially, bonds or debt that is owed by the United States government towards those who are lending to the government in order to continue spending and fueling financial deficits, right? That's generally speaking the purpose of treasuries here. Now, treasuries themselves, they have not only their base value, but outside of that as well, they pay a yield. And generally speaking, in accordance with the federal funds rate, that's the Fed funds rate or the interest rate that the Federal Reserve manages in order to increase or decrease the base cost of capital, you're generally going to find that if bond yields are moving higher here, they are pricing in a higher Fed rate hike. To really visualize this here, I'm going to go ahead and bring us here towards the quarterly chart. And I want you all to take a look here at what's happened here over the last few decades. We're looking back all the way towards the 1980s. So I really want to emphasize that what we're experiencing now is something we have not seen in multiple decades, even before the 1980s here. We are seeing a reacceleration of bond yields. We're seeing essentially a bond bear market because the principal value of bonds usually decline when yields are moving higher here. Right? I know it might not make total sense here. It might be a bit confusing. You don't need to understand all the fundamentals of it, guys. But the key point here is that you can get essentially what is seen as a risk-free rate of return of around 4.942%. This is the highest rate since 2007, much different from where we were back in 2020 or even back here during the mid part of the 2010s, where generally speaking, rates for the 30-year yield were around 2.4 to 3.5%, accelerating at a rapid pace here. And we're not just seeing this for long-term treasury notes that mature over a 30-year window. You're seeing it on the 20-year yield, you're seeing it on the 10-year yield, you're seeing it on the 2-year yield, and also the multi-month yields here. Generally speaking, short and long-term treasuries are going through a big thing here. And we've been again talking about this here. What I have here on the chart is generally kind of a measure here of where we really think treasury yields are going. This is a chart that we share exclusively within the Dash report. It was part of our article this month here. So if you guys want to see more data around this here, I definitely recommend you guys check out the Dash report down below in the description. And this is again a great way where you can support the channel, but also get an additional kind of 33% of content on top of the free stuff we put out here in the channel. But we hinted here that we are entering in towards a long-term period of rates where we're going to have suspended higher interest rates, not just in the federal funds rate, but also in government bonds or US treasuries. Essentially, fixed income assets like bonds and debt are going to be paying much higher rates than they used to in the past. And this is going to cripple the investment thesis for investing into risk-on assets like the FANG stocks, investing into ARKK, the innovation ETF by Cathie Wood, and the likes of all those who are trying to kind of find the next big technology companies. It is going to cripple investing in a whole range of stocks out there that rely on promoting themselves through their dividend yield. And it's also going to cripple, at the end of the day, high risk on assets like cryptocurrencies. And I would say it even goes as far as to potentially hit Bitcoin and Ethereum. Don't believe for a moment, guys, I'm not being some perma bear here, that is going to have some impact on crypto. When you have something, generally speaking, can protect your principal and at the same time give you a fixed yield, that is going to entice a lot of investors and change the dynamic of liquidity flow from certain sets of assets into others, i.e. from risk-on assets into passive fixed income assets like bonds. Now, I want to go ahead and spend some time here to talk about really the critical chart here, right? Because I understand everyone has different interpretations here, maybe around the bond market and what's really going on here. But generally speaking, I want you guys to take a look at the one chart that really matters here. This is the one takeaway. If you guys take away anything from this video, this is the chart you want to see, right? So let's take a step back. The Federal Reserve is continuing to have to raise interest rates higher. They're having to do this here because essentially the price of oil is continuing to rise higher. The price of other commodities like natural gas are moving higher here. And essentially speaking, that is leading inflation to start to rebound here. And because the market is starting to, unfortunately, at a year-long delay, finally come to this realization, a realization we talked about for more than a year now, a bit frustratingly here as we're quite a counter opinion towards the mainstream narrative. Essentially speaking, similar back to the 80s, we are going towards a yield curve inversion here. Now, essentially, short-term yields here are going to be moving lower here versus the rate of, okay, I'll take a step back here. Let me explain this a bit better. Essentially speaking, because the Federal Reserve is continuing to raise interest rates here, and they're going to have to continue keeping them up at a longer period of time, this is going to mean that bond yields are moving higher here. What we experienced here, though, during a period of easing and the Federal Reserve accommodating financial markets is that since back here in 2009, we continued to see that shorter-term bonds were starting to pay a higher yield than long-term bonds, even eventually moving in, as we've seen throughout history, into negative territory. Now, what does this mean here? It means that essentially the short-term bonds, in this case the US 2-year yield, is paying more than the 10-year yield. And if you think about it from a logical conclusion, that just doesn't make sense, because a longer-term commitment of debt should pay a higher yield, right? You're betting on the US government repaying you over a 10-year period, right? Versus a 2-year period. You should be getting more for that. That's how debt would generally work in the world, right? And it just makes logical sense, I think, to most people. However, there are these periods of time where, crazy enough, essentially speaking, there are anomalies where we get essentially a higher rate here on the 2-year yield of shorter-term treasury maturities versus long-term treasury maturities. This is usually measured with the US 10-year yield versus the 2-year yield. Now, what's really interesting here is that a lot of people have pointed out here this idea of, oh man, Nick, we've been hearing so much about a recession. We've been hearing so much about a recession. Where is it? Where is the recession? We're going to have the soft landing. That's the narrative that so many people have been betting on, that we're in a new bull market and things are just back into la la land. The Fed can print money and do whatever, right? Unfortunately, the Fed cannot just print money. They cannot just pivot and lower interest rates here. They are going to have to wait for something to break. And markets are finally coming to that conclusion. We've essentially started to uninvert the yield curve here. Now, some may think that that's a good thing. It's actually the worst thing to happen, because the problem wasn't just when we decreased here, when we were going into negative territory. It's like a rubber band. The longer we stretch this to the downside, down towards a historic low for multiple decades, far beyond the 1980s here, we have essentially gotten to such a level of distortion that when this springs back up, we are going to start entering into a recession. And don't believe me, let's take a look at history. What happened when the yield curve bottomed here in 2006? Well, in December 2006 here, that was leading to 2007. That was pretty much a year precursor here towards the housing crisis, right? Actually less than about 6 months, as the pain started to come in 2007 into 2008. So essentially, this was your precursor to the recession. What about here? The lows here in April of 2000, what was happening then? That was the peak of the dot-com bubble. And from there on out, technology stocks in the NASDAQ wiped about 70% of value. Over 95 to 98% of IPOs went away and they never came back. All right. Now, surely we are not in the same environment as the dot-com bubble, and we're not probably in the same kind of housing bubbles we were in 2006. And back here in the 1989 period, where we had the major flash crash in markets, right? It's not exactly like it was back then, but history doesn't directly repeat, but it certainly rhymes here. Essentially means that with this distortion here, I don't know exactly what it is that's breaking the economy. It could be a lot of different things, as it usually tends to be in recessions. But I got to tell you guys, some things are about to break. And that is likely going to mean that we are going to get a real, proper bear market. I'm not talking here about the NASDAQ's correction here, where from total top here to bottom, it only went down 37%. I'm talking about a real top to bottom 50% correction in valuations. And if you understand, as we've talked about here in this channel, guys, what so many people miss, unfortunately, is that those additional 5, 10, 15, 20% declines make up a huge difference here, right? As we continue to measure from top to bottom decline. So we likely, because of this year-long delay here, this relief rally, if we are not really in a new bull market and we are going back down to the lows and even further, we have just delayed the inevitable and probably caused more pain than needed. Because the Federal Reserve didn't tighten aggressive enough, it didn't reduce its balance sheet, and other central banks followed suit, being very passive and waiting for the economic data. Because of that, we are going to have to take on the additional weight and pressure of even higher interest rates and even more tighter balance sheet contraction. It's unfortunate, but it's the decision that the Federal Reserve made. And quite frankly, as much as they have tightened interest rates, as we've said here on the channel, they haven't done enough. They've been the same institution that told you inflation was transitory. They're the same institution that said we're going to wait for the economic data to play out. When in reality, inflation has yet again started ticking higher. Oil is ticking higher here to its highest level since November 2022. An entire year of progress wiped out in just this past summer. And other commodities across the world are still rising up here, even though global central banks are still declining liquidity here, back towards those relative lows in September, or the same level we were at in August of 2020. It's because of the fact here that we still have nearly a $5 trillion or a $4.5 trillion premium in liquidity that was printed over the past few years versus where we were before the pandemic. We still have so much excess liquidity in the system. And if you don't believe me, guys, take a look at the data here. The job openings in the United States, the forecast was 8.8 million, right? Essentially where we were, a little bit below where we were last month. And guess what we got? We got 9.6 million job openings in the United States currently existing on the market. A huge upset, canceling the past few months of progress and the Fed's work on tightening the economy. This is not good. This is an inflationary sign. We can see here again that the Federal Reserve is doing what many people see as many people see it as that the Fed is doing so much here in order to, contract the money supply and stuff. We have echoed it time and time and time again here in this show. They're not doing enough. They're not doing enough, guys. And this is the visual sign of it here. Why are companies still hiring? Why are they still opening up new positions? That is going to increase the competitiveness in the labor market here for employers, and that is going to lead towards higher wages, which is unfortunately not something you need when you're trying to fight inflation. I'm not against paying people a fair wage in the long term, but unfortunately, the time forward is not during inflationary phases in the economy where people are trying to deal with the increased cost of living. We need to essentially cool demand in the economy. We need to bring back equilibrium to supply. And again, this does have ripple effects here in crypto, guys, right? If this means that the Fed is going to have to continue raising interest rates, which is going to make it more difficult to borrow capital, it's going to be more expensive. If it means that the Federal Reserve is going to have to continue, as well as other central banks, in declining global liquidity down towards more moderate levels, back in line with where we were back here in, say, 2018 on the balance sheet, so it means we're moving trillions of dollars of liquidity, that is going to hit crypto. That is going to have a sizable impact here, especially when it comes to stablecoin liquidity, which has been the institutional liquidity on-ramp into crypto. I know some people say, Nick, people buy Bitcoin, Ethereum, and all these cryptos in spot markets. Yeah, some people do, but at the end of the day, that's mainly retail investors, guys. When you're talking about hedge funds, family offices, all these different institutional wings, even Wall Street and all the different types of institutional investors there who may want to invest in this space, they're likely buying through stablecoins. And there's a direct reason that why, when we saw back here in March 2020, when we saw the biggest wave of QE in the history of humanity, we essentially saw the overall increase in USDT and USDC, the two major stablecoins in the market, increase by a whopping 2,183% from that range towards its relative peak in May of 2022. And it's a big reason why since May of 2022, we snapped through the prior support range at 30K for Bitcoin and have not been able to really get above there since we've been contracting over 19% of stablecoin liquidity, which, by the way, if we just turn off the drawings here, looks like it's ready to move to new lows. It's not showing any serious sign of really bottoming here or rallying back up. So liquidity is not on our side here, and that does have impacts on crypto. We cannot sit here for a moment, guys. We cannot sit here and argue because of the halving event, because of BRICS and de-dollarization, or whatever narrative you can think of, the Bitcoin ETF, whatever it may be. We cannot sit here and say that Bitcoin is this hedge against money supply debasement and that it should go up when there's new money in the system, right? Like it has been for the past decade, and then simply ignore when it's contracting. Bitcoin works in an opposite effect here. It hedges that money debasement to the upside. When you print more money, Bitcoin's value should obviously increase to some degree. And during periods of times of monetary contraction, it should struggle. It should generally be moving lower here to the downside. Maybe not today, maybe not this week, but generally speaking, over the longer term trend, it's going to have a really difficult time because liquidity is the lifeline. It is the blood of all financial assets to continue appreciating. Again, that's the reason why every single time when we had 15, 20% dips during the last secular bull run in equities back during 2010 to 2020, every single time we had some pullback, say here in 2011, 2016, here in December 2018, here in March 2020, the Federal Reserve always would come to the rescue. And that's why we would just simply buy the dip. Now, when you're having continued contraction and the Fed no longer can print money because they know it's going to be reinflationary, they're already struggling to get inflation down, and it's likely going to be like that for the next 6-12 months here, even at current pace of monetary policy, then essentially we should sell the rallies. We should sell the relief rallies and expect lower lows and lower highs each and every time. And I think that's a big reason why we were not able to clear here through the resistance range that was prior resistance in February and April 2022. And if we are really not in a new bull market, if we can't reclaim new all-time highs here off of AI or whatever narrative you want to go off of as a potential call for a new bull market, then we're likely going back down, or at least at a minimum, we're going to be chopping here for some time. I think your best case scenario is that we kind of just chop here for the next few years, similar to what we did if we go back here into the S&P 500 back in the 70s, right? We had this expanding funnel here during a growing age of inflation here into the 70s. And equities had essentially what we would call a lost decade where they didn't perform well. And I understand this is equities. You might be saying, but Nick, crypto is so small. Crypto could very well outpace this. It could be an anomaly here. I got to tell you guys, I wouldn't bet on it. I wouldn't put my money on it personally. I would be leaning in the opposite direction. Crypto does follow in the broad performance of assets, and the bigger it gets, the more it's going to fall in line with it. We've got to be really cautious here, guys. And I want to bring it back here to Bitcoin, more specifically in a price analysis perspective. Bitcoin's price performance really, to be completely fair here, for the past couple months hasn't been entirely bearish here. I'll say that as someone who leans more bearish, the price action, it's doing okay. We've been sitting sideways since back in March. That definitely shows some resiliency for market participants to not want to lead prices down here towards the prior capitulation range. But keep in mind that that can change. And if investors who are buying up here, who are providing that current support while some people are selling, right? If they don't see that there's enough other bulls on the market who are willing to market buy alongside them and eat up the asks on the order book and continue pushing prices higher, because market order flow, the market buy side pressure, is what is required to really drive a bull market. If all those who have been market buying for the past couple of months realize, there's really not enough momentum to clear through this prior support range that's now acting as resistance between 28K and 32K, so people are going to start cashing out. And that's essentially what causes this domino effect of rolling over with lower highs and lower lows and unfortunate realizations that prior expectations are not going to be met and that there's more credit contraction, less money in the system, liquidity is not on their side. It's this psychological unwinding of realizing that the good times are not here right now and they're not going to be here for some time. And it's time to pack up shop because we got to pay down our debts. We got to start battening down the hatches, strengthening our financial balance sheet, and essentially preparing for a recession. And that gets back again towards, you probably heard me earlier saying, and I want to kind of close off on this, the concept of a catch-22. We are either in a recession or if the Fed pivots here, which would be the worst mistake. Sure, stocks and crypto might bounce up in the near term for a little while. They're certainly not going to kick off a whole new bull market, even with that. But if we get a Fed pivot here, if the Fed really decides to lower interest rates or try to respond immediately towards any potential breaking in the economy, I got to tell you guys, we're entering into a long-term depression, and I wouldn't touch most financial assets with a 10-foot pole. If the Fed does that, we better not be cheering. We better be taking advantage of some short-term optimism and then running for the hills as soon as possible. I hope more than anything we just get a moderate recession. right? It's going to be one of those two, guys. I'm sorry, there's no room here for a soft landing where rates are going right now. Something is either going, the Fed, in order to cool inflation, is either going to, continue tightening aggressively and break something, and we have a bit of cool down and equilibrium in supply and demand. We remove some of that excess liquidity in the system, or the Fed is going to pivot here, and we have some short-term optimism continuation for the next few months, and then we will likely have reinflation, and the Fed's going to have to come back even more aggressively. I don't mean to be negative, guys. There's just too many people out there telling you what we want to hear. And I always try to take things from an optimistic angle. We've done that. I've done that for the last 12 years of my trading journey since 2011. I believe in the number going up and to the right, but even though that may be true in the long term, there are extended windows of time, multiple years in fact. Take a look at the dot-com bubble, take a look at 2008, take a look at many recessions in the past that come around every decade, decade and a half, 2 decades, that are going to take back a lot of those gains, and they're going to get a lot of people sidelined. And sure, I could sit here and promote my Bybit referral link. I could encourage you guys to go leverage trade and get liquidated and overtraded the market, which would, of course, enrich me utilizing those leverage trading exchange referral links, which I'm not going to do. A lot of creators do that out there. But instead, I'd rather be honest with you guys and let you know what my thoughts are on the market. Now, if there is one way where you guys, again, want to find out what we're trading and investing in, we just dropped this month's edition of the Dash Report. It's a 20-page plus report, and we focus in on crypto, stocks, commodities, and Forex. You guys can find it at the link down below in the description. Get 20% off. We've got hundreds of members in the community here who are really active, really kind, and intelligent people, some of the best and brightest from our community. And if you feel like you're in that camp where you're eating up what we talk about here on the channel and all the free content we put out, the Dash Report could very well be a community that you'd like to join, and we'd love to have you as a part of that community. But again, you guys are welcome to try it on a monthly basis, and if you like it, then you can upgrade to annual later on for a 20% discount. There's a whole range of different things we toss in here. We're constantly trying to build on that offering and trying to offer it at a fair price. But that's it for today's video, guys. I'm rambling on a good amount. If you guys like my rambling here, consider dropping a like. It's one of the greatest ways you can support the channel. I know it's a bit heated here today, but man, this is the first time, guys, in like I would say a year where I feel like things are really starting to move. Things are really starting to set in stone. I haven't been this kind of concerned about things since August of 2022 when Jerome Powell gave the speech that really set the tone for future Fed monetary policy. We've been trying to warn about this for a long time, and I want to share as much as what I'm finding here in the market with you guys as possible. And yeah, anyways, I'm going to leave it at that, guys. Again, if you liked the video, consider dropping a like, maybe share with a family or friend member. But until the next video, I'll see you guys on Friday. Take care, stay safe. I'll see you all in the next video.